Oh, good afternoon, colleagues. Maybe we wait 1 more minute for others to join us. Okay, so I think we can start. So first, let me thank to all the participants who kindly agreed to contribute to this event. The topic is very timely and relevant. We're talking about financing North Africa's transition to green economies, and it's part of our preparation to the policy dialogue that will take place at the very end of this month in Zimbabwe, in Harare, for the entire Africa. Sometimes these days we talk about just and sustainable transition, but the idea is very similar. So the idea is that we gather some main messages and we take them with us to Zimbabwe for consideration of the ministers in their activities. So first of all, biggest thanks goes to Amandine, who organized very skillfully this event, and to the entire team that supported her, and to our participants. So let me just mention how the event is structured. First, Amandine is going to give us a brief overview of the issues. Then we're going to look at the role of the private sector, because it's very clear that without private sector contribution, there will not be adequate funding. Then we will move into public debt and also sustainable bonds. And then we will also look at what ECA is doing to support countries to mobilize climate finance. So again, why is this particularly relevant for North Africa? I mean, we know the topic is very relevant. It is a major challenge, but it's also an expensive one that will basically need funding. And our region has specific challenges, including water scarcity, but at the same time being subject to floods, so desertification. So there are also specific angles we need to look at, and it is severely underfunded. I mean, it's getting very small fraction to what, for example, East Asia is getting in climate finance. It has contributed very little to the climate change, but it is disproportionately impacted. So Amandine, over to you, please. So maybe I should introduce you briefly. So Amandine is an economic affairs officer in our office for North Africa. Before that, she was in headquarters, and she also has experience from the African Development Bank. So over to you, Amandine, please.
Thank you, Susanna. Good afternoon, everyone. Good morning, depending on where you are located. I will be talking about financing the South Africa transition to green economies. I would ask, okay, the presentation is on. Thank you, Hamza. So I will talk about financing North Africa's transition to green economies, and I will focus mainly on challenges and opportunities in the region, but also on the African continent as a whole. Next slide. So globally, the climate crisis has been intensifying, and extreme weather events have become the new normal. African continent has been the most affected. The African continent has been the most affected region by climate change. However, its global greenhouse emissions are minuscule at global scale, accounting for only 3.8% of global greenhouse gas emissions. Nonetheless, the impact on lives and livelihood have been devastating. In 2022 year alone, over 110 million people were affected by climate change. Drought and flood have worsened agricultural productivity, therefore intensifying the continent's dependence on food imports, worsening current account balance, as well as displacing productive investments. The largest emitters of the continent include South Africa, Nigeria, Egypt, Algeria, and Ethiopia. While looking at the estimates from Climate Policy Initiative, we see that Africa will need 2.8 trillion to implement Africa's national determined contribution over the period 2020 to 2030. And the largest economies of the countries, which include South Africa, Egypt, and Nigeria, will comprise over half of the climate financing needs. The IPCC also predicts that climate change impact will be severe in North Africa and in the southwestern part of Southern Africa on the continent. This means that this region will need substantial investment in climate adaptation. A review of the 2021 updated NDCs for the 5 North African countries, Egypt, Mauritania, Morocco, Sudan, and Tunisia, shows that it will require 393 billion USD to implement NDCs. And of this amount, nearly 3/4 are allocated to climate mitigation. That is around 288 billion USD. Next slide. While the overall climate financing flows fall short, they are falling short. The financing for adaptation seems particularly difficult because of investment in adaptation always take a longer time horizon, but also it is more difficult to ensure cost recovery and profitability. On that basis, Africa received only 20% of global adaptation finance flows annually in 2021 and 2022. This was less than half of the financing going to East Asia and Pacific region, which received about 45% of global adaptation financing flow. But on a broader scale, Egypt and Morocco and South Africa received almost 1/3 of all mitigation finance dispersed in Africa. And in North Africa, despite the pressing adaptation needs, current adaptation financing represents less than 30% of total climate finance received. And you know that climate change adaptation priorities in North Africa focus on agriculture for improved food security, the integrated management of water resources and desalination, and the coastal zone management. When we look at the table on climate financing needs in North Africa, we see that Mauritania has huge climate financing needs of 59% of GDP, while other countries, Egypt, Morocco, Sudan, and Tunisia, their climate financing needs vary between 4% of GDP and 7% of GDP. Therefore, delivering on ambitious mitigation and adaptation projects will require substantial mobilization of both domestic and international funding. Next slide. Looking at the climate finance flows to North Africa by type of financial instrument, we see that climate finance flow to North Africa were almost exclusively in the form of debt-based instruments, despite the large debt burden that many countries in the region are currently facing. There are also regional disparities in received climate finance. In the sub-region, for example, Egypt and Morocco, they have been successful in attracting public international climate finance, while countries such as Mauritania and Sudan received only 3% of total flows to the sub-region. Also, on a continental level, close to 80% of the adaptation finance in Africa comes from loans and government budgets. And we know that with the current poly-crisis, countries have used up all the fiscal space available to undertake development and investment activity. Many countries cannot take on new market rates foreign denominated debt. Therefore, given the challenging debt situation, the mobilization of more grants for adaptation is more urgent than ever. But also, on this, it is worth noting that African government themselves invest more on adaptation for climate than the support they receive from bilateral development finance institutions to the region. That is when we compare 19% versus 11%. Next slide. So to mobilize financing for a green transition, it needs to be done on three-pronged approach: mitigation, adaptation, and of the cost needed for climate actions. We know that the tax GDP has been increasing, and the current 15% that we have must increase to 30% so that it can provide government with a fiscal space needed to invest in climate action. This can be done through phasing out fossil fuel consumption subsidies, as well as developing efficient carbon market trading system. A study by UNECA shows that Africa can mobilize up to 6 billion USD by 2030 and up to 100 billion USD by 2015 through carbon market alone. The second source is the Multilateral Development Bank. We know that the international financial system has been dispersing 100 billion annually, adding to the 30 billion annually by the International Development Association. But these resources, they are inadequate to tackle the triple challenges of poverty, securing a sustainable planet, as well as ensuring prosperity for all. Therefore, MDBs need to be capitalized, but also they need to be reformed to become bolder and better and be able to attract more resources and have larger impact. So to restore trust, MDBs need to be adequately funded, but also there is the Bridgetown Initiative and the Nairobi Declaration, which propose innovative ways of using concessional financing. We know that debt to GDP has been crowding out investment for climate actions. Therefore, using tools such as debt for nature swap can provide access to additional financing for countries. The third source of climate financing is the private sector. Private sector has a huge potential to meet climate financing needs on the continent. However, globally and in Africa, the private sector finance for adaptation has been less than 3% over the years. Therefore, the opportunity for commercial financiers and private enterprise to develop and mobilize adaptation solutions, product, and services is enormous. Based on this fact, we know that transitioning to a more inclusive green growth agenda offers Africa, and North Africa in particular, the best opportunity to accelerate growth, provide jobs, transform their economies, and build thriving and prosperous societies. Thank you. Thank you, Susanna. Over to you. Thank you.
Yes, thank you, Amandine, for this very comprehensive and useful introduction. So we will now move to the area that you highlighted has huge potential, which also means it has been really untapped so far. So we don't want the potential become missed opportunity. So over to Jerome Washer from the IMF. He's a senior economist at the International Monetary Fund, currently covering Saudi Arabia. Recently, before that, he was an IMF rep in Tunisia, so has great experience from our North Africa region. Also, IMF rep in Ukraine, with its own challenges, and also experience from French diplomatic service before that. So he has recently co-led a paper on actually this very topic on financing of the private sector. So over to you, Jerome, please.
Good afternoon, and thank you for inviting me. I don't know if the presentation, yes, very good. So this is basically on a paper that we have just released, just published. And maybe to give you a bit of context, this paper was done in following a series of other work that we have done in our department, which is the Middle East and Central Asia department, which covers a large number of countries actually, because we cover from Mauritania to Pakistan and from Kazakhstan to Sudan, so a very diverse range of countries. So again, to give you a bit of background, we had some previous papers which focused on, one was focusing on mitigation, the other one was focusing on adaptation. And here we were really focusing on financial sectors, and in particular domestic financial sector and the financing aspects, but also the risk aspects. So maybe if we can turn to the following slide. Thank you. So here we looked at, initially the way we approached it, and we looked at both the aspects of risks for the financial sector and the challenges and opportunities for the financial sectors of the region to develop climate finance, essentially. So we had these two strands, but we also quickly realized that there are a lot of interactions between them. And actually, if you want to develop, and that's something I will come back to later on, if you want to develop climate finance in the region, you really need to address the issue of risk for the financial sector, the issue of data, and transparency, which are key in this area. So again, this background of paper poses three key questions that policymakers face in the region. And again, that's a pretty large region, but we also have some country granularity in our paper, including on North Africa. So one is, what are the financial stability risks in the Middle East and Central Asia region for climate change? Two are, what are the region investment needs for climate change mitigation and adaptation? And three, basically we look at how the financial sector role can be leveraged to attract more private climate investment in the region. You can move to the following slide. Thank you. So the first thing that we do is, and as part again of this risk assessment, and here I'm giving you some basically some of the key messages and some focus on selected aspects of the paper, because this is quite a number of elements in the paper. We look at the impact of climate risk and physical climate risk, and on that part there are two types of physical climate risk, which one is acute, what's so-called acute physical climate risk, and the second is more chronic physical climate risk. Acute physical climate risk is basically the impact of disasters such as hurricanes and floods and so on, and the physical and the chronic ones are more related to, for example, the rise of the sea level or things which are manifested in a longer period of time. So we looked at a number of countries where we had data, and we tried to simulate the impact of the climate disasters in particular, and we tried to make some simulations over a longer period to see based on current trends, and basically assess the impact of on the banking system. What we found, and again, this is quite a difficult area, in particular because of the number of assumptions that have to be taken, and also because of the data issues. But what we found that could have an impact of about 1 to 1.5% of assets of banks, which of course of the loan portfolio would be a bit more, and cumulative credit losses, which would be in excess of 50 billion for the region. You can move to the next slide. We also look at a very important aspect, which is transition risk. There we look more specifically at the impact of let's say, carbon price increases on economic sectors and how this would affect banks in the region. And there again, we also need to take a number of assumptions. These are basically stress tests related to a fossil fuel price increase and basically a one-time shock. Of course, in reality, there's a lot of gradual adjustments that can take place, but it already gives you an idea of mapping the risk and where they could be. So we looked at different carbon price adjustments. Some are in line with what would be an objective considering the targets in terms of emissions that are put in place. And so we look at an increase of two types of increases of carbon price. Here, I just want to emphasize that the current estimates for carbon price in the region are very low. So that is a significant adjustment for the region, and they are very low also because of the impact of energy subsidies. So in any case, this is a significant impact on the banking sectors of the region, and in particular on some sectors which are more energy intensive. And an increase in carbon price can also take place, for example, through the carbon price border adjustment for the EU. So for countries which are important trading partners of the EU, that's also an important consideration and a type of shock that needs to be considered. Can go to the next slide. What we noticed both for physical risk, importantly, mostly for physical risk, is that there are limited buffers due to small insurance penetration in the region. That means that the burden of these shocks has to be taken either by the government or by the banking sector itself. So that's why we also find relatively high pass-through from these shocks to credit losses. There are a lot of differences within the region in terms of insurance penetration. For example, Morocco and the UAE have the highest insurance penetration, but otherwise it remains very low across the region. Can move to the next slide. So now we look at the financing needs, and some work has been done, as mentioned before, in other institutions. That's a typically quite complex issue to tackle. We didn't want to completely reinvent the wheel, and we looked at different estimates, including the ones from the NDCs, which were mentioned before. And basically, across the region, the range of climate financing needs are between $150 and $450 billion a year. Because we had estimates of cumulative financing needs of 1 trillion to 2.2, 2.8 trillion by 2030. Of course, that again depends on the achievements of the targets and a number of assumptions. But these are obviously large. As a matter of comparison, in some of the regions that we looked at, for example, in Asia Pacific, those needs are around 1 trillion a year. But still, they are very large for this region. The financing needs for climate mitigation are, again, larger than for adaptation. But what the issue is that in low-income and fragile states, they face disproportionately higher financing needs, especially for adaptation. And they also are the least prepared with a weak financial development, limited fiscal space, and already high debt. Can move to the next slide. So what we see is that there has been a development of green and climate finance in Middle East and Central Asia, but it's way inadequate compared to the climate investment needs that have been identified, and especially the contribution of the private sector is very low and concentrated in a few countries. So, for example, in the GCC. What we find, though, is that the domestic financial sector have substantial potential to expand in climate finance. What we see is also an important role for innovation, including through green bonds and Islamic finance. And what we find interesting, and we have a box on that, is a blending of green and Islamic finance that is quite unique to the region. And also what is quite unique to the region is the role of sovereign wealth funds. We have, again, in that large region, we have about 16 sovereign wealth funds, which manage $4.6 trillion in assets. And they play a distinctive role, and they are also more and more involved in the issue of in climate finance. And we have a whole annex on that, which with country by country information. What we found also, and that is quite important because less attention has been paid to that also in other regions, is that local banking sectors are actually well positioned to channel funds to specific segments and areas that will require high energy efficiency. And that includes some corporates, but also the household sector. And there, for example, in the area of housing and in terms of energy efficiency, there's significant needs. And the banks are, local banks have the operational knowledge to do that. So that was also something that we looked at, because a lot of attention is paid to bond flows and so on, but much less to the role of domestic financial sector. There is also a particular challenge for oil exporting countries where bank funding is strongly correlated with oil prices. And in fact, it's on the liability side where we find a lot of exposure of banking systems to fossil fuels, rather than on the asset side, especially in some countries. So that's more of a long-term challenge, but that's particularly important to underline. You can move to the next slide. So we, to conclude, we had some policy recommendations in the paper, and we had some heat maps, so-called. So looking at the implementation of different policies and what could be the priorities in terms of implementation. What we did was to have actually several heat maps. So this is one of the summary heat maps, looking at what the financial sector can do, what governments and central banks can do, what should be the and where we have more detailed recommendations, what should be done in terms of the operating environment for this to thrive. There has been a lot of progress on climate commitments. We have seen all the NDCs, although very often there is no strategy in terms of financing, or a clearly identified strategy in terms of financing. There is, of course, a lot of issues related to taxonomies, data standards, and that's something that the international community is working on, but is fundamental both for risk and for developing climate finance, because banks are telling us that basically they cannot even assess what they are doing in terms of climate finance and in terms of climate change if they don't have the proper tools to assess what statistically they are doing, what is the contribution to climate change, and what is the risk component of that. In terms of medium and long-term priorities, I mean, there's a number of them. I will just focus on one, which is particularly important in the region, which is the role of energy subsidies, which are particularly large in the region, at $389 billion for the whole region, and for MENA only at $336 billion a year, which in some countries the average is about 7% of GDP. So this is really significant. It's not only a distortion for the fiscal on the fiscal side, but it's also an important disincentive for the private sector to invest and make some investment relevant. So that is an important task in terms of policy, and quite prevalent in the region. So I will stop there, and I will be glad to take your questions during the discussion. Thank you very much.
Thank you very much, Jerome. This was very interesting and informative. Maybe two quick questions since you started about the subsidies. It's really a challenge. Do you know about any country that has successfully phased them out? Of course, the political context always, not to put you on the spot, but political context always matters. But is there some maybe good practice how to do it?
No, we have, I mean, of course, we have a lot of discussions with many countries on this issue, which is not an easy issue, as you said, for political reasons, in particular social reasons. And we always push to put in place basically to replace these subsidies with subsidies which would be more targeted to the people who actually need it. Because one of the aspects of the energy subsidies is that they tend to subsidize actually the rich more than anything and the highest consumers of energy more than anything. So that's something that can be put in place. Of course, it's not an easy task, but it can be done. Outside of the region, there are several countries which have done it. Then there is also in the region, for example, if you look at the issue of fuel prices, there are a number of countries which have reformed it, including Morocco, for instance, where actually the prices have been quite liberalized. If you compare Morocco and Tunisia, they're quite different situation, but also the UAE and so on there. So depending on what subsidies what type of subsidies you look at, whether it's fuel subsidies, electricity subsidies, subsidies on gas, there's a number of ways to do it, and a number of countries which have worked on that.
Yes, and of course we have subsidies in Morocco of sugar and others. So yeah, it's a complex. So we don't want to go on the tangent. So maybe more broadly, role of central banks. This is quite important. I think French central bank was quite pioneering some years ago, getting countries together. So what's your view on that?
I mean, in our paper, we emphasize quite a lot the role of central banks. Not only as financial sector supervisors, as they are in in a lot of the countries. I mean, also in a number of countries, we have an independent financial sector supervisor, separate from the central bank. But they have an important role to play, obviously, in terms of risks, in terms of statistics. We also looked at what the central banks were doing in their financial stability reports and how they were assessing the impact of climate change. So there are a number of central banks in the region which have taken a proactive stance. The one in Morocco, for example, had the strategy in 2021, but also the one in Egypt was looking at the impact of climate change. So that's one part of the question. Then there is a whole other area which is maybe a bit more controversial, which is being discussed quite a lot in advanced economies, and in particular in the euro area with ECB, is what could be done on the side of monetary operations, for instance, and how to take into account climate change. But there, that it's already not very advanced in some of it's in the euro area in other countries, although a lot of work is being done. But in the region, there's clearly not much that has been done.
Yeah, thank you. And as you said, it's controversial whether this should be the goal of monetary policy or not. So yeah, so I think this is very useful. Because Jerome may need to leave early. Is any of the colleagues having a pressing question they would ask to now? They would like to ask now.
And the paper is on our website, so I don't know if you.
So we will share it after the event today. Okay, so with that we move to Sonia, who will also be speaking about basically the role of capital markets and risks and investors. Sonia is from ECA. She's heading the private finance section in the private sector department right now.
Thank you, Zuzana, and good morning, good afternoon. So allow me to stand on existing protocol. If we can move to the next slide, please. Thank you. So just as Susanna was explaining, I lead the Innovative Finance and Capital Market section at ECA. So that section belongs to the Private Sector Development and Finance Division. And as you can see here, we work with most sub-programs within ECA, but we also work with our sub-regional offices. The main mandate of that team is really to enhance capacity of member states, to deepen the financial markets, but also to mobilize long-term finance for the sustainable development. So if we move to the next slide, I want to discuss the work of ECA, but with three different perspectives. The first one is, how do we empower our African institutional investors? Because from the previous presentations, we know that the private sector has a key role to play. But when you look at, the ability of our institutional investors actually to allocate some of the asset under management for green/sustainable assets, it's very limited. So when we say African institutional investors, we refer to pension funds, insurance companies, and social and sovereign wealth funds, sorry. So based on the latest figures that I have in mind, they are mobilizing more than 100 billions of USD in terms of asset management. So you can imagine when we talk about the investment and financing gap in Africa, those are key actors that we do not want to leave behind. However, they face, many barriers and challenges. One is, the lack of enabling policies and regulations, and I think it was mentioned in the previous presentation. Limited availability and accessibility of climate-friendly projects, high perceived risk and cost. Unfortunately, green is not always cheap, and low capacity and awareness. So I put here, just also, this is food for thought, possible ways to overcome these barriers and unlock really the potential of African institutional investors for climate finance. One could be, of course, through strengthening policy and regulatory frameworks that can support and incentivize climate-aligned investments. The second one could be developing and scaling up innovative financial instruments. We mentioned, the potential, the opportunity for North Africa to blend green and Islamic finance. So basically, there is room here to scale such instruments. And of course, also think about the de-risking mechanism so that we can reduce risks and, of course, the cost. Another option could be to build and, of course, diversify the portfolio of bankable and sustainable projects. Priority should be given to projects that address the climate finance needs and priorities of African countries. And finally, enhancing the capacity and awareness of investors and other stakeholders on the opportunities and benefits of climate finance. So the second angle I took is on how we can leverage capital markets in Africa. So through our capital markets, we can trade, different type of financial assets, but they have a key role in mobilizing and allocating climate finance. And of course, it could be through, providing access to long-term and diversified source of funding, and also through enabling risk management and price discovery. We have also to take into account some of the challenges, but opportunities for enhancing the role of African capital markets when we talk about climate finance. Again, you will see that the regulatory frameworks and standards for green and sustainable finance across the continent is critical. The private sector needs to understand what we call a green asset in our context. Building capacity and awareness is important. And when I say building capacity, it's the capacity of market participants such as issuers, investors, intermediaries, but also regulators. They need to be able to understand what a green product is in order to regulate and put in place appropriate frameworks. Expanding and diversifying the pool of climate finance instruments and products. There is a strong potential here as well. I know colleagues mentioned carbon credits, biodiversity credits, so we will come back to this at a later point in the presentation. Leveraging the potential of digital technologies, such as fintechs, blockchain, artificial intelligence, and all this can also contribute to reduce the cost. And finally, strengthening the collaboration and coordination among different stakeholders. I think if we really want this to work, the entire system needs to be prepared. So the third angle is the risk perspective. And since we have a lot of representatives of member states, I choose to tackle sovereign credit rating. Most of the products that were mentioned are also based on the financial rating of potential issuers. And when we look at the sovereign credit ratings in Africa, most of our countries are basically non-investment grade, meaning that the risk premium they will pay to issue is already, for plain vanilla product, is already quite high. So when you include the green component, it does not make it cheaper, because the first thing that would be considered is the creditworthiness and the default risk of that potential issuer. We see now that credit rating agencies are kind of integrating ESG factors. ESG stands for environmental, social, and governance in the sovereign credit rating process. And of course, it can significantly impact the rating of a country. What are some of the challenges and opportunities to integrate ESG in the rating process? So one is, and here I'm talking about the challenges, availability, quality, and comparability of ESG data. Unfortunately, we are not there yet, and this is an area where we need to work. The lack of harmonized frameworks and measurements, whether we talk about indicators, transparency, disclosure, but there are also some opportunities, like it could foster a better alignment with the global sustainability goals and standards. And of course, it could also foster the development of growth of the sustainable financial markets. So my last slide would basically be about ECA work on climate finance. So concretely what we do. So based on the three main topics that I've addressed, I wanted just to mention what we do. When we talk about capital market development, we, for instance, work with colleagues. And please, I represent one specific section, a sub-program within ECA, but we are working all to, most of our sub-programs are involved in the various initiatives that I'm mentioning here. So building capacity on carbon markets, we are currently considering strong programs on how we can then, foster a transaction around carbon markets. Egypt, for instance, recently has started listing the voluntary carbon credits. So this is maybe an experience that can be shared with other stock exchanges, and we can see how we can also, to some extent, and this is a long-term perspective, create regional stock exchanges for carbon markets and biodiversity credits. Two is legal and regulatory reviews. We mentioned the role of central banks, so we work closely with them. It's true, we do not just consider the climate angle, but basically the broad markets. We're also working with central banks and ministries of finance on developing bond market strategies. And through those strategies, we include the climate component. And of course, benchmarking is important. So basically, we are working with APSA and OMFIF. We are supporting the work on the African Financial Market Index. And you will see that index has 6 pillars. And one of the pillars cover sustainable/climate finance. So this is what we do on capital market development. The second substream of our work is on institutional investor and risk. I mentioned the lack of capacity of institutional investors. So we have designed a program to enhance capacity of institutional investors in West Africa. But this is something that we would like to also scale up. We are also building capacity when we talk about sovereign credit rating or even ESG rating. So we work with different partners, and probably some of them are even part of this meeting. So, and through different activities, research, online courses, technical workshops, capacity building, specific countries or technical assistance specific to countries. The third substream is innovative finance / innovative debt management. Here we basically want to align finance with sustainable objectives. So for instance, ECA has that initiative led by a Standard Bank called African Women Impact Fund. And we have aligned that fund with the key sustainable development goals, and notably the one covering climate finance, climate action. And two is through promoting sustainable debt management programs. So currently we are working with very specific countries on public debt swap. So with this, I will conclude my presentation. Thank you, and happy to take any questions.
Thank you very much, Sonia. This was very informative. I particularly agree, I mean, with when you were mentioning the credit rating and most of our countries being in sub-investment grade. So that's a major deterrent to investment. Of course, if investors can form their own view about risks, and that's why the de-risking work is so important that you're also doing, that will change the landscape. So after this, we are now going to move on to bond markets and including sovereign bonds. So our next speaker is Cecilia Murai, who is a senior specialist in capital markets, finance for sustainable development Africa. She has several decades of experience, also working with UN and World Bank Group. And she has also advised to UNECA, to our institution on that sustainability and sustainable investment mobilization. And she also worked with African Union. So over to you, Cecilia, please.
Thank you so much, Susanna, and distinguished guests. Thank you so much for inviting me. It's an honor to be here. And I've had the pleasure of working with the ECA on a number of projects. So this is really an honor to be here today. So I will, as mentioned, I will speak a bit about the role of the sustainable bond market in terms of moving the green economy and the opportunities that can be created when issuing sustainable bonds. So I will showcase that with some examples. So we can perhaps take the next slide. I just had a few short introductory slides about FSD Africa, but I will skip those because this is just for reference. If it's Financial Sector Deepening Africa is a development agency funded by the UK government and others, focusing on capital market development. So that's it in a nutshell. You can move to the next slide again, I think. So kicking off then with the sustainable bond market, you can go back to the next slide, it's fine. It's a pretty picture. That's what I want. A picture says more than 1,000 words. And this is really just illustrating what we want to achieve with the green economy and the sustainable bond market. We have heard already about many of the underpinning potential policy and regulations that can be in play to support the green economy, all the way from just basic environmental and pollution protection legislation, because let's face it, if we are not protecting from harmful emissions and pollutions, then everything else is futile. But moving from that, to the institutional investor base and how to integrate sustainability into institutional investor stewardship, capital market listing regulations for corporates, for example, in their ESG disclosures, tax incentives, whether this is for green projects and equipment, but also there are examples across Africa where the green bonds are tax exempt. Examples are there in Kenya and Zambia, for example, where this just makes it a more attractive proposition for investors in the bonds. And also other instruments related to the bond market may include the partnership with the multilateral development banks and utilizing the opportunities around blended finance. And in the bond market, that mostly applies in terms of credit guarantees. So where the MDBs can pay for, should there be any failure to meet payments, there is that guarantee that the MDBs can provide. And this, of course, makes it more attractive for investors. So these are all tools that can underpin a successful, sustainable bond market. And really what the bond market is trying to do is to harness new technologies, business models for the green economy and create better financing terms for raising capital to develop those projects. And you can go to the next slide. Let's see. So in the sustainable bond market, there are a lot of different terms, and it may come across as confusing, but what I wanted to show here is that there are really two main categories of sustainable bonds. You have the green or environmental bonds that focus on environmental benefits of the projects, and you have the social type of bonds, which include benefits for social purposes. So this could be increased job creation, it could be investment in health and education, it could be promoting women-owned businesses. And then you have the mix between the two, which then becomes a sustainability bond, where you have a blend of benefits across both green and social. And so then anything else is really a subset of the green or the social bonds. So you could have gender bonds, SDG bonds, blue bonds. We also have the green sukuks. They're an example of issuances of green sukuks, which of course are the Sharia compliant debt instruments. And it really is just emphasizing the existing environmental stewardship that is already embedded, but just highlighting what kind of investments are being focused on. And this could be in renewable energy, in agriculture, in across all sectors. So this was really just to illustrate that it's quite simple. Next slide. So this is, again, a description of different types of bonds, and traditionally, these bonds have been use of proceeds bonds. So financing pre-identified set or portfolio of projects. But now, recently, the ICMA, the International Capital Markets Association, have also issued guidelines for what we call the sustainability-linked bonds, which are general use bonds that can be used for any project, but there need to be key performance indicators and targets that are met as part of the commitment by the issuer. So that creates a little bit more flexibility, but also it puts a lot of requirements on the project management across all activities to ensure that these targets are met. We can go to the next slide. So this is just to illustrate the strong growth of the sustainable bond market over this past 10 years. It's really grown exponentially. And this is based on investor demand. Investors, the majority of investors, I should say, they acknowledge at this point that climate social inequality, and other sustainability factors can have an impact on financial return. So they see green and other green bonds and other sustainability instruments as better from a risk perspective. And additionally, there's a shortage, there's a stronger demand and an undersupply of these instruments. So this also creates some of the benefits that I will mention in a moment. Maybe we can switch to the next slide. We can also see here that green bonds are traditionally the largest portion of the sustainable bond market, followed by social and sustainability-linked bonds, which are sort of the new entrants. So just coming back to what are the attraction then? So for the issuers, it is really mainly the fact that you can get better financing terms, so better rates and tenors, and because of the sustainability content of these bonds, there are also the guarantees and other blended financing opportunities available, and which in turn makes it more attractive for investors. So there tend to be strong oversubscription, and additionally, investors globally have made commitments to invest a certain portion into green and sustainability instruments. So these instruments are really attractive for them. So for the investors, again, really these instruments are seen as better from a risk perspective, but also increasingly investors are also such as pension funds, long-term investors are recognizing that part of their mandate is to actually contribute to a better society for retirees to retire into. So therefore investing both for risk mitigation, but also for impact, social environmental impact is important for the investors. So these are so this all in all, this makes the sustainable bonds an attractive proposition, whether it's for sovereign issuers or for the private sector issuers. And when it comes to the sovereigns, when sovereign issues a green or sustainable bond, that sets a useful benchmark in the market that private sector can also follow. So this is also why it is useful to consider for sovereigns and for the government in promotion of the green economy. You can switch to the next slide. And this is just to indicate a list of the issuances that have taken place to date on the African continent. And this is really a mix of private sector. These are banks and non-financial corporates. We have sovereigns. So it's really to show that this is green and sustainable bonds are appropriate for any type of issuer. And we have had many successful issuances on the continent. And the pipeline is also very strong across the continent. You can switch to the next slide. So just to flag, I had actually added some information to this slide, but I've highlighted these here because they are examples of recent issuances that were very successful. In particular, in Latin America, we had a number of sustainability-linked bonds, but also debt for nature swaps. But for the sustainability-linked bonds, there were long maturities. Chile and Uruguay, they issued 20-year maturities. They were between 4 to 6 times oversubscribed, and leading to a lot of new investors, so really broadening the investor base. I think it was the Uruguay, they had 21% of their investors were new investors, so globally. And so that's really indicating the strong investor interest. We also saw this successful issuance by Cote d'Ivoire, which was indicating a greenium, as we call it. So there you could see that the tranche that was green had a better rates, better pricing than the traditional tranche. And of course, in the North African region, Egypt and Morocco have led with the issuances already. And we've also seen the Moroccan Capital Markets Authority issue gender bond guidelines recently. So there's a lot happening globally and also on the African continent with examples from the sovereign issuances. Maybe the next slide. And there is a lot of information available. So these issuances, they are guided by international standards like the International Capital Markets Association, which has a lot of guidance available. So this is just to flag that. I think I will jump to one of the final slides because I think I had 15 minutes, so I'm not going to overstate my welcome. Just want to show example of support that is available. Let's see which slide that can be. You can switch. So this is for reference. Maybe if these slides are shared, you can have a look at some of this reference data, just showing the trends, the use of proceeds, what are the most common sectors. You can put the next slide. And the next slide again. This slide is just showing that any sector can be greened. So sometimes there's the misconception that green is something small and niche, but any sector can be greened. This is the taxonomy of the Climate Bonds Initiative. And these issuances should be aligned with the national priorities, whether this is in the energy transition plan or just the national development plans. The international guidelines can be used as inspiration and you can align with that, but it should really be aligned with the national priorities. You can skip to the next slide. So this is just as a final slide, just showing that there is a lot of support available in the market for private sector and government issuers, because these are new instruments. And so it's useful to pick up free support that is available from many organizations, including FSD Africa, where we can support with identifying, the appropriate projects, the appropriate strategy, whether this is for a use of proceeds or a sustainability-linked bond, whether it's for rollover and refinancing of existing debt or new capital. So really defining the strategy in terms of what product mix would work. And then also capacity building across ministries and for the private sector issuers as well, taking the process all the way through development of the bond framework that is required, and the issuance report support in terms of external verification and engagement with creditors to make sure it's a successful issuance, all the way through to the reporting on the sustainability bond. If the procedures are set up well in terms of data collection and monitoring, then the reporting will not be an added burden. So I'll leave you with this slide, and thank you so much for your attention. I will also put in the chat a toolkit that is available on green bond issuances if there's further interest. Thank you.
So thank you very much, Cecilia, for this comprehensive overview. Of course, you made it sound, as you said, it's simple and very appealing, but we also heard from Sonia about the cost associated with these bonds. So when you talk about less risks, we need to also look at the return, right? So, and I think on balance, the trade-off is not so clear that, so there are still some hesitation. I think globally it was Poland who issued the first sovereign green bond in 2016, and it created a lot of questions whether this is really green. But yeah, so
I'm happy to comment, but you are absolutely right. Yeah. Do you want me to comment?
Yes, please.
Yeah, so on the cost, yes, there is additional effort in terms of identifying projects, setting up project improvement plans for sustainability-linked bonds and the reporting. But that is also why there are these special programs available where you can get free support, take an issuer through the entire process with experts, and that is funded. And you can also get this external verification that is required, that can be paid for. So this is to encourage, this is one of the ways to encourage the green bond market to develop and the expertise to build. So that subsidy is there. And then on greenwashing, as we call it, the risk of overstating the environmental or social benefits, yes, that is always a risk. And but with the green bonds, you would need to identify and report annually. And I think since the first issuances some 10 years ago, the market has improved in terms of the frameworks and the guidelines that are available. So there is added robustness to the issuances. But of course, that is always work in progress, and it's always down to the intent and the will of the issuer. But they run a significant risk in terms of reputational risk, of course, with investors, regulator, and the public. So that is something that issuers really would like to avoid. So for the most part, it's genuine and robust in terms of the preparation and the issuances.
So thank you, Cecilia. We are now moving to the next presenter. He's now our constant partner in these events. And it's Mokhtar El-Hussein, who will be speaking about ESCOA, which is our counterpart in Arab region. ESCOA is experience with debt for climate change swaps. Over to you, Mokhtar, please.
Thank you, Susanna. You heard me right?
Yes.
Okay, thank you. I will talk about the ESCOA climate SDG debt swap donor nexus initiative that we have launched a while ago. We have started promoting this, and it seems to be very attractive to our member states. Next slide, please. We will be setting the scene to have a quick overlook of the situation of debt in the middle income countries and low development countries in the Arab region, to put things in context. And then we will talk about the need for advancing debt solutions. We'll talk about the limitations and benefits of debt swap. And we will talk about the initiative itself, how we have developed it and what it consists of. And then the co-benefits for the debtor, the creditor, and the donor of such an initiative. And then we'll show you what we suggest as milestones in putting together a debt swap initiative for a given country. Next slide, please. So as you see in these graphs, there is high and persistent fiscal and current account deficit in middle income countries and low income countries in the Arab region. This is a constraint for their ability to meet expenditure commitments and then driving the need for borrowing. This graph is self-explaining. It shows that the shift in external debt composition in middle-income countries and low-income countries in the Arab region is characterized by increasing borrowing from private creditors. Bilateral creditors hold more than a quarter of the external debt of sovereigns in the middle-income countries and low-income countries. The shift has led to an increase in external debt service, consuming a higher share of revenues and export over time. Next slide, please. As you see in these slides, in these figures, public climate finance in the Arab region falls severely short of what is needed to implement the nationally determined contributions NDCs. Over the past decade, Arab states received a total of $34.5 billion in international climate finance, relative to the financing required to implement the nationally determined contributions of the 11 Arab countries. This amount is equivalent to less than 6% of the financing needs in the Arab region for the coming decade. In addition, most of the finance is in the form of debt, not grants, as seen in the second figure, 62 billion. Okay. So we wanted to set the stage. Now, the need for debt swap is very obvious. It's very clear that it can be among other solutions. We don't proclaim that it can be the only solution, but it can be. It has been advocated by ESCWA on the launch of the initiative in 2020, advocated by the Sustainable Development Coalition 2022, and emphasized in the outcomes of the Paris Summit 2023. So our initiatives is aligned with the international move. And the climate debt swap initiative of ESCWA aims to help improving the preparedness of the governments to the scale up to debt swap. Developing a climate the initiative would be in line with the national priorities, including the NDCs that we have talked about earlier, and it is at the heart of the Paris Summit outcome. Now let's move to the limitations and benefits. As you know, I'm sure you know it better than I do. Debt swap refer to an agreement where transactions between the creditor and the debtor may entail putting in place a mechanism to restructure the debt. It's not. It is a commitment to relieve the debtor and to reallocate the cash coming from the repayment of debt towards targeted objectives. This is that's where we have developed the initiative to increase the liquidity of the country to serve the strategic objectives of the creditor and to make the best use of the money and increase, of course, the cash available for the country for meeting the objectives set in the NDCs. Some key lessons in the past swaps, debt swap that have been put in place, which are different from the initiative that ESCWA is putting. Some conditionalities may involve trade-offs with national priorities. Small scale debts also swaps for project poses difficulty in attributing impact on the development outcomes, external liquidity, and fiscal space. High transaction cost procedures for especially in commercial debt swap. Commercial debt swap have potential also to have an adverse impact on sovereign credit worthiness and access to capital market. So now the next slide. The ESCWA has developed this initiative, which is a preemptive debt swap without debt restructuring. It is to be in line with national priorities and the national development programs. It is a programmatic approach with key performance indicators. It is within a planned medium and long-term objective to enhance the fiscal space. It is also within the donor nexus, so it is done in a way that is attractive to the international donors, to development finance institution, MDBs, and credit enhancement facilities. Next slide. So the initiatives has been put with result-based programs with key performance indicators, and at the project level, at policy level, for the selection and monitoring of the program, which can also accelerate policy reforms and transformation impact. Next slide, please. So in this initiative that is being proposed by ESCWA, the national priorities and projects are identified through a process of consultation with different stakeholders, and these consultations take into account the needs, the vulnerabilities, the priorities of the country, and lead to different various studies to make sure that the program is robust and improves debt sustainability. Next slide. So we have started with Jordan. In that case, the government established an interministerial task force to operationalize the initiative. This task force includes representatives from the ministries concerned. The task force, in cooperation with ESCWA, has finalized a proposal with the climate SDG debt swap program towards achieving the objectives of Jordan in its NDC's priority actions. So that's our first example, which we are proud of. We have worked a lot on such a proposal, and it has come to being adopted by the government of Jordan, and Next slide, and coming to the stage where it has been operationalized, which involved arrangements, as you see, between the debtors, the creditors, and the donors, as you see in the chart in front of you. Next. As you see, we have put in this slide the benefit for the debtor. So we spoke about them to a certain extent before. The benefit for the creditor and the donor benefit as well. Next slide, please. So building with our experience in developing such an initiative, and as a result of our consultations with our member states interested, not only Jordan, but all other member states, our suggested milestones include the establishment of the task force at the national level, as we have seen with Jordan, to assess the sovereign debt repayment over the medium and long term by type of creditors, and identify the priority sectors and programs and projects in line with the NDCs and NDPs, and consult with all stakeholders to consider their perspectives in developing a national program and its monitoring and evaluation strategy, so that we don't leave anybody behind. We integrate contributions of all stakeholders, whether in civil society, in government, in other entities, and we make sure that it is a win-win initiative. We suggest also to take the following action: to develop a climate SDG debt swap program with key performance indicators in the framework, and to design the financial conditionalities that make sure that the incentives and the obligations and implications on the budgeting exercise are taken into account. Engage with credit rating agencies and international financial institutions to make sure that the initiative helps reducing risk of lowering credit, access to borrowing from capital market, and building trust of investor and people. And finally, mobilize support from creditors and donors. Thank you very much, Susanna. I hope I have not been long. I must apologize for my colleague Niranjan, who was supposed to do this presentation, but his mother passed away, and he couldn't come to this meeting.
Thank you very much, Mokhtar, and very sorry to hear about Nijaran's mother, so please pass our condolences and sympathy. Yeah, so my colleague Khaled will later speak how we will actually be working with you on applying this initiative also to our countries. So it's highly relevant and interesting. Of course, it's part of the solution, and then there need to be others. So I think Zubir actually will be speaking more broadly about the debt burden and some of the issues that it's causing for climate financing. So our next speaker is Zubir Ben Hamouche from our office again, and yeah, so he will be speaking about climate finance more broadly and the debt. So over to you, Zubir, please.
Thank you, Susanna. Good morning, bonjour à tout le monde. Donc, so I will, as we have discussing for 1 year, 1 hour and a half, maybe to leave some space for discussions. Try not to be too long. Next slide. So we need to, in discussing the way we tackle sustainability transition and the debt issue, we need also to put in balance the urgency of the situation, to clearly understand where we are wrong with what we are doing and how we could think differently. So the urgency quickly is that we are about to reach the 1.5 degrees by the end of this decade, and most probably 2 degrees by the middle of the century, given the trajectory of emissions we are in and our capacity to reduce emissions sufficiently. And at such level of increase of temperature, climate scientists say that we can question our capacity to adapt. So, and unfortunately, this is not only an issue of warming, because we have all those dimensions which are important, critical for our conditions of living on Earth, which have been summarized in 9 planetary boundaries. We have crossed 6 of them, and almost to cross 2 others. So almost 8 of 9 planetary boundaries are going to be overpassed, and it's a critical issue for our living conditions. And climate is reducing our growth prospects, and it's directly threatening the stability of the financial system globally, and of course for the debt crisis for Africa. At the global level, the debt has reached more than 300 trillions of USD, and the problem is that the productivity that we derive from that, because we issue debt to finance something for development, investment, and so on, has declined, as it can be seen looking at the ratio of debt to GDP, which is almost 350% in 2023, and government debt is also soaring with an increase of 76% in 15 years, reaching more than 100% of GDP. And the problem is that this debt is a burden on SDGs, because we have 3.3 billion people who live in countries where governments pay more on debt, so interest payments, rather than on health and education, which are critical for SDGs. Next slide, please. And Africa, the situation is even probably worse than at the global level, because Africa is the most vulnerable country, and at any scenario above 1.5. And North Africa, as it was stated in the beginning, is also a very critical position in the globe that makes it a hotspot. And in terms of that, the damages are exponential and posing a big threat, a big systemic risk to all dimensions of African life: health, jobs, and infrastructures, everything. UNECA has estimated this cost to between 300 billion, almost 300 billion, more than 400 billion, depending on the warming scenario. But there are other estimates by other institutions, or probably we are underestimating this, because the models that we have currently, not in Israel but globally, are not well capturing climate. And in terms of debt, 90 countries in Africa are in this position of paying more on debt than on health and education. Africa's debt has increased by 183% since 2010, whereas GDP has more than four times than GDP. So the ratio of debt to GDP is soaring. And we have currently more than 27 countries who have a ratio of debt to GDP above 60%, which is considered the ratio of sustainability, above which sustainability is an issue. And in terms of impact of climate on debt in sub-Saharan Africa, there is an estimation of almost 1,000 billion in debt in the next 10 years to deal with climate. Next slide, please. So the problem is that we have to escape from a vicious cycle that we are trapped in, which is that we need more debt, but to finance a slow productivity growth, but high impact on climate. And then, because we are not able to fight climate change, we are called to have more debt to absorb shocks and finance the same type of growth that is leading to the problem. And the other issue is that with depletion of fossil fuels and our tentative to go towards renewable energy, we are moving from really a world of abundance, and we are seeing now we are moving to a world of scarcity. So we cannot take the same level of debt in a world of abundance to a world where scarcity will prevail, and so with less growth and less income to deal with this debt. So the view is that to enable sustainability, finance sustainability transition and deal with the debt in Africa, we necessitate three things. The first one is to view debt differently, because debt is partly and a large part is the legacy of an unjust, and as African countries are saying it, an unjust and ecocide economic model that has benefited, if we look at the repartition of well-being in the world, it has benefited disproportionately to a small fraction of the world's population, and unfortunately to the detriment of the future of developing countries' population and Africa's population. And moreover, this debt has a huge counterpart in terms of, we are talking about global warming and planetary boundaries. It has a counterpart in terms of degradation of natural capital. Between 1992 and 2014, the natural capital per head has decreased by 40%, which is really huge. Natural capital is critical for every aspect of our life, and in particular for our food security. And if we balance this with SDGs, we have only 50% of SDGs that are on track. So there is something wrong here, because we are destroying our environment more rapidly than we are creating well-being for the populations. The second point is that Africa's financing issue and globally the financing issue of developing countries cannot be thought in silo. They have to be put in a global agenda of reforming the financial system. The third point is that when looking at solutions to address Africa's debt and financing issues, we should align that burden to sustainability, because currently it is not the case. And the solutions, next slide, please. The solutions that are currently on the table, all the channel of the SDRs, the G20 Common Framework, and many other solutions are not sustainable solutions. They are only short-term solutions, and they are in fact in line with what we are trying to do to tackle climate change, which is just to try to green the economic system, while a more abundant literature now has been produced to show that greening the economic system as it is not possible, given the quantity of energy it necessitates and the quantity of metals that we would need to keep the same economy, but greening it completely. And this will fail then for at least 4 reasons. The first one is that, as we can see, global warming is continuing. We have not been able to stop it, and the costly extreme events will increase and become more costly. So it will increase the burden on Africa and the vulnerability of countries. Inflation will be higher. We have experienced it in the past months and years, and it will be the case in the future. High interest rates, and mostly a weakening in the financial system, because the financial system is not able currently to grasp the risk associated with climate change, and also to take into account its own impact on the biosphere and climate. So Africa will suffer highly from high adaptation costs, slower growth, and high cost of recovery from shocks, leading it to rely more on the debt in an elusive quest for higher growth, which may probably not happen given all the scenarios of global warming and its impact on growth. Next slide, please. So I submit here for discussion three pillars that are completely intertwined and complementary pillars to address the financial issue and debt issues. The first one is discussed for a long time, but we have difficulty to put it in place, is the wealth tax. The wealth tax is critical for many issues. First is to reduce incentives for infinite capital accumulation, which is a big problem that has led to the global warming and overpassing of planetary boundaries. The second one is reducing inequality, and reducing inequality is critical if we want to mitigate climate change. Otherwise, and research shows that it will be very, very difficult to tackle this. The third one is to raise funds to fund climate action and for example, the transition of developing countries. And the fourth one, which is really important, is to better align owners, capital owners, entrepreneurs, and innovation also with the objective to have a more climate-friendly economy. The second pillar is incentives and regulations for the financial system. As I said, and there are also data on this, currently the financial system is not financing the transition. If we look at the energy part, for example, we are very far from what we have to do to achieve net zero. So incentive and regulation for the financial system to boost the financing of the transition, and most importantly, to modify the distribution of return on capital in the favor of climate-friendly activities. For currently, this is not the case because we are still financing activities and subsidizing activities which are very detrimental to climate. The third one is to ease the allocation of resources towards new climate-friendly activities. Mitigating climate and adapting to climate is fundamentally a process of structural transformation, and the financial sector has a big role to play in that. And lastly, to promote climate-friendly innovation. And the third pillar, which is challenging but not impossible to do, in fact, I call it a climate debt haircut. Because as I said, the debt that we have now comes from an abundant world, and we are transiting to a scarcity world. So we need to, restructuring will not be enough to deal in the long run, on the long run basis, to the issue of debt. So the idea would be to reduce overall the burden of debt on the transition to a more climate-friendly economy, especially for vulnerable countries, and to increase the leverage on debt. Currently, the leverage on debt is very low. As I said, the productivity of debt is decreasing. Fourth is to ease the allocation of resources from old to new activities, and lastly, to ease the reconversion of stranded assets, because fundamentally we have an issue with mitigating climate change, adapting climate change is really an issue of stranded assets. Next slide, please. For the second pillar, just a quick few ideas on that. Still work on progress. The idea would be to have something like a Dodd-Frank Act, which was done after the subprime crisis, but on climate, to deal with systemic environmental impact. And the purpose would be to have regulatory incentives to propel the financing of sustainable transition. We could treat assets differently in terms of capital requirement and taxation, according not to the risk. We have talked about physical risk or all this, but according to the damages that they impose on the biosphere. For example, we could have different classes of assets depending on their degree of potential transformation. We know that some assets cannot be fossil fuels, for example. These are stranded assets, clearly, to go to a net zero. But there are different between this and a very highly climate-friendly activity. There is a continuum. We can define different type of assets depending also on what we could more put on the definition. And we could have also differentiated public policies depending on the class of the asset. Next slide, please. The third idea would be to have some kind of a bank of transition. Because I said that we have stranded assets, and there are many people demonstrating because they think that the assets are threatened by the fight against climate change, which is right. So we have these stranded assets that we have to deal with. And a bank of transition, whose shareholders, so it will be central banks, whose role will be to accompany the transformation of our assets and the restructuring of public debt. And lastly, the climate debt haircut for Africa. Most probably, a climate debt haircut will be more powerful if not targeting specifically a region, but we could start with a specific region like Africa, and of course having a lot of designing it such as to avoid this kind of moral hazard in the future. But the idea would be to have a universal scale down debt burdens in return for verified concrete climate action, and with greater relief available for African countries, because also they have a unique challenge. As I said, this is the most impacted region of the world, and they need to leapfrog. as it was said by African leaders in the last Climate Africa Summit, there is a need to leapfrog. But to leapfrog, you need financing. And I will conclude in a few. No, come back. Just to say that there are many ways and forms to design this climate debt haircut, and there are also many things to do to make it work in terms of how it impacts balance sheet of different investors and so on. But it could have differentiated ways to take into account that nations are very different in terms of vulnerability to climate, the climate impact on future growth, the debt level, and so on. Next slide. So I finish with a simple example of how we could compute in a simple way, but it's just an example, an haircut that is rigged, an haircut rate that is linked to climate. We could use, for example, cumulative CO2 emissions and not current ones only, because it does not reflect the contribution of each country to global warming. So we use cumulative CO2 emissions by country, and we could then affect to each creditor a weight equal to the share of its economy in this cumulative emission. Then we could estimate the impact of climate change on future growth prospects for African countries or group of African countries, depending. And then we will define the haircut that is a function of creditors' weight and the impact on growth. Or alternatively, instead of taking growth, we could use the adaptation cost of each country and apply the same item. Thank you.
Thank you, Zubir, for this very interesting presentation and comprehensive. And I think you have reiterated the point several times that we're moving from the world of abundance to scarcity. So the point is, like, countries cannot grow out of that anymore. First of all, the productivity has declined, but also the growth is not acceptable, without sustainability. So now we are moving to our last, but perhaps the most, let's say, practical and implementable presentation. What are we doing in North Africa, and how can we support our countries? So our next speaker is Khaled Hussein, who is the Chief of Section of Special Subregional Initiatives in North Africa Office. And this work is part of the special initiatives. So over to you, Khaled, please.
Thank you, Susanna. Good afternoon, colleagues. In fact, this presentation will be a continuation of what Sonia has presented. This is also on, this presentation is on what ECA is doing to support member states in the area of climate finance. So I have selected 5 activities. Next, please. I have selected 5 activities that ECA has engaged in. They represent the past, the present, and the future. So those activities are the African Climate Policy Center. It also includes the Debt for Nature and Innovative Financing Solution for Debt Sustainability, as well as the new initiatives that we will launch soon on fiscal restoration for sustainable development. And the 5th one is a project that UNECTAD, ECA, ECLAC, and Financing for Development New York is involved in. Next, please. Next. Okay, so this center, the African Climate Policy Center, basically ECA recognized the severe impact of the climate change on the African economies, on poverty, and that's why ECA established the African Climate Policy Center in 2010. And since the inception of the center, ECA has implemented enormous programs of work. Next, please. This includes programs related to climate information, strengthening resilience, climate policy, and climate governance. And those are just some examples of the programs that has been implemented by ECA Center. Next, please. Debt for Nature is ECA has already engaged in providing technical assistance to Cabo Verde throughout the negotiation between Cabo Verde and Portugal to swap some of the debt for nature. And the good news is last year in 2023, the agreement is being signed between the two countries for an amount of $153 million for a debt swap. And as Sonia, I think already she said that she's leading also in some programs. ECA has the intention to continue this program of debt swap also in West Africa. I understand that there are number of requests from countries from West Africa. Also, we are happy to join hands with ESCWA in North Africa and to try to implement the debt swap also for Egypt, Tunisia, and Morocco. Next, please. This project mobilizing external financial resources for greener, more equal and sustainable development in 5 vulnerable small island developing states. 2 of them are already in Africa. And this project started in 2022 and will be completed by the end of 2025. And we are doing it with UNECTAD, ECLAC, and DSA, which is the Financing for Development Office in New York. It includes 2 African countries, Cabo Verde and Comoros. And this project is trying to help the countries in 2 ways. First is to do an assessment framework to determine the funding gap related to climate change. Second is to help the countries to implement a national external financial strategy that includes, again, climate-related innovative financial tools such as green bonds and debt to climate swap. So ECA is involved in this project in 2 countries, Cabo Verde as well as Comoros. Next, please. This project will be led by Sonia and again in partnership with FSD Africa. We have Cecilia with us. We are in the process of developing a project, a global meaning African project, to help to support the member states to develop sustainable finance products. And this will include products related to climate, related debt swap, carbon credits, as Sonia already mentioned, and sustainability-linked instruments. Next, please. Last activity or initiative I would like to talk about is the Africa Physical Restoration for Sustainable Finance. And this initiative will start hopefully 1st of April. And we are trying here to help our member states who are in liquidity crisis or in debt distress to be proactive and to take control of their debt situation before the situation deteriorates further and the countries get into default. So we have 4 pillars in this initiative. Next, please. The first pillar is to help member states to establish a comprehensive debt database, to have a coherent coordination mechanism between the stakeholders, mainly the Ministry of Finance and the Central Bank. And also in the first pillar, we will help the countries to do technical analysis beyond the DSA analysis, the debt sustainability analysis, and to do technical analysis for debt reprofiling scenarios. And of course, the countries may wish to do this exercise and to go beyond to renegotiate with the creditors. Also, as I said, that Sonia is going to lead, this is pillar 2, the development of sustainable finance tools. And this pillar also may include engagement with creditors. In fact, this, I think Cecilia and Susanna tackled this issue of when you develop sustainable finance products, sometimes countries, they find that the cost is higher than the traditional bonds, for example. And ECA here will really try to not just to help the countries to develop the products, but also to secure some guarantees to have a reasonable cost for the new sustainable finance products. Next slide, please. Also, I would like to highlight that the ECA is currently the secretariat of the SDC, Sustainable Debt Coalition. That is an African initiative that came already in COP27. And also, in addition to being the secretariat, we are going to help our member countries to be engaged with the credit rating agencies, as well as supporting the MDBs to increase their capital. Parallel to these 3 pillars, there is another most important pillar, which is the capacity development. So while we are helping the countries to do their analysis, to get engaged with the creditors and so on, we are also implementing a capacity development program to help the countries to have the skilled staff who can do those activities and to implement those pillars without any external support. So I think, Susanna, I will stop here. It's just, this is a highlight of some of the activities that ECA is already implementing to support the member states in the area of climate finance. Thank you.
Thank you very much, Khaled. This is very useful and informative, and I particularly appreciate the balance between looking at new and innovative financing, but also looking at the overall fiscal space, because at the end, that will need to be addressed. I mean, without some changes, innovative financing alone will not solve the issue, but of course it is very helpful. So I think now we can open the floor, and colleagues, any questions you presenters? You can either raise your hand or you can send it by chat. So maybe one question I have, this I don't see it. Did I miss any question? So, you know, in our region, we have several challenges. Let's not talk about problems. So one of the challenges, of course, inadequate financing. But even within the financing the region is getting, be it North Africa or Africa, most of it goes to mitigation, even though the region contributed very little, in fact, to the climate change impact. And then a lot of it also goes, very little private financing, a lot of it goes to just few countries. So in North Africa, it's Morocco and Egypt that receives most of the climate financing. So how can this transition be more just in terms of who is getting the money and for what purposes? So any of you, if you could share your view, please.
I think there is Fatima El Tahir.
Oh, sorry, I missed that. Yes, Fatima. So please, your question.
Good afternoon. Very thank you for this very fruitful meeting in our region. But I have a common comments. All the presentations that are in line with what we are need to know and to do. My question is that we are in need of having analysis for risk factors, because climate change now become a very dangerous issue. The solutions are there, recommendations are there, but when we come to finance, I'm not going to say zero compared to the large damage that caused by climate change for our countries, but it is not significant compared to the losses. Even conflict now in most of the area It is not only a political conflict. It's, if we look at the root factors of this conflict, climate change is one of them, just like in Sudan. It started by the competition over resources in the west part of Sudan, and each tribe tried to compete and to take the huge portion of the resources, and it starts from there. And now, as you see, it become a national conflict and also affected the region. So let us analyze the risk factors, the root causes for the climate change and the conflict and everything, and look to enhance the mobilization of resources and to think of implementation rather, because there are huge amounts planned, but when we come to implementation, not significant. Thank you.
Thank you very much, Fatima. You raised a very important point for our region, which is the migration induced by climate change and parts of the region becoming unlivable. Actually, I think I didn't mention that project, but we do have a project on migration, and perhaps part of this will be also looked there. Now, when it comes to attracting more financing, I think this is exactly what everyone is trying to think how to do. So colleagues who would like to comment further or answer Fatima's question?
I guess Sonia, if Sonia is still with us, I think her work is more relevant to what Fatima was saying. Sonia is here.
Yes, I'm still here. Thank you, Fatima, for your question. I think regarding risk, I completely agree with you. There is a need for further support. And you see in my presentation, I mentioned some of the risks that we are willing to cover. So maybe when we say risk, I think there is an element first of data. And as I've mentioned, we do not have enough data. We do not have strong or supporting regulations. So it's, I think there are different building blocks. So it would be interesting, of course, to work with colleagues from the Subregional Office and notably Khaled, because in his presentation and the initiative that Khaled presented, there is an element where we can also assess or address climate risk, and the impact on public finance, but also on the population and the private sector. So I think we can make that link, but risk implies that we also support member states in developing the appropriate tools. And if we want the appropriate tools, we need to also be ready to work on data. And lucky for us, within ECA, we have a division that is covering data and statistics. So I also see them playing a big role here. And we have another division working on climate change. So clearly, ECA can team up and design a program that will make sense for the sub-region. Thank you.
Thank you very much, Sonia. And in fact, I think we are already working on some de-risking documents where we'll one of the challenges for Africa is that it has very high perceived risks, which is disproportionate to the actual risk. And this comes from investors not really fully understanding the continent, the opportunities, etc. So thank you for that. So colleagues, any other question?
In the chat box, Susanna from Qatar, she's asking about the debt swap, whether if debt swap is also applicable to internal debt.
Okay, thank you, Khaled. So maybe we can ask Mokhtar, if he's still with us, to answer the questions, because you were talking about the debt swap.
Well, I cannot see Mokhtar.
So I guess anyone else who would like to talk about debt swap?
I think if you allow me, Susanna, I think most of the debt swap that took place so far is a bilateral debt. You know, it's between governments. But theoretically speaking, there is nothing that can stop the debt swap to be applicable also to internal debt. But this didn't happen so far. And I guess Sonia wants also to elaborate in this.
I guess just to
Okay.
clarify, sorry, by internal debt, we mean domestic debt, right? So
Yeah.
yes, most of the restructuring so far applied to external debt, certainly the initiatives of World Bank and IMF, but more and more we are speaking it should apply to domestic debt as well. That's especially as the share of the domestic debt is rising. Sonia, over to you, please.
Thank you. So we haven't seen a lot of initiative on internal debt swap. However, what we sometimes see is government rolling over part of the internal debt. So it could be by, different way of restructuring the debt, like extending the maturity, for instance. This is something that we have seen regarding internal debt. But we also need to be cautious here. The idea of swapping with external partners is also, to repurpose part of the funding. So if we do it internally, it means that the government might not be paying, domestic investors to do something else. So this is interesting, but we also need to take something else into account, is the maturity of the debt. In most countries that we have been covering so far, domestic debt is usually over the short to medium term. Whereas when you talk about debt for nature swap, we are also considering, long-term debt, because it usually takes 6 months, if we are very optimistic, to nearly 1.5 years to structure such program. And it's a shame that Mokhtar is not here with us. He could have shared the experience of Jordan, how long actually it took to structure, that debt for nature swap program. So if the debt is over, a short-term period, it might not actually be relevant, because by the time you finalize your program, the debt will have to be redeemed. Thank you.
Thank you, Sonia. So any other questions, colleagues? Otherwise, yeah, we are doing actually very well on time, exactly within the time limit. So I think we are taking some important messages. Yeah, unless I'm missing some other questions. So we are taking some very important messages to the COM, and then we will also be sharing all the presentations with you, and then we will be also sharing the findings of the COM. Perhaps in conclusion, we can also mention once again that most countries in our region are middle-income countries. So their challenge in North Africa is a lack of access to concessional financing. And with that also often comes shorter-term financing borrowed on financial markets, and then a need to roll them over. So making them basically more accessible to concessional financing is one of the key challenges, and most of them also are, as was mentioned by colleagues, by Sonia, in sub-investment grade, so that doesn't help for good financing. So I would like to thank to all our participants, to all our presenters, and of course, as always, last but not least, to the entire North Africa office, because everyone contributed, of course, under the leadership of Amandine, and also with great contribution of the sub-regional section who works on this topic. So many thanks to everyone, and we will be continuing our discussion. So thank you.